Okay, everyone, what an incredible week we've had. This has probably been the most extraordinary week that's really happened since the global financial crisis. Not because markets have gone down, but all of the things we have seen in the last week. If somebody would have told you a few weeks ago that the British government would essentially be saying we're going to guarantee 80% of people's wages and that liberal democracies would be closing down restaurants, bars and so on, people would have thought you're crazy, right? So this once again shows that nobody can predict the future, especially the short-term future. One of the most underrated Warren Buffett quotes, because it's so simple, he says, stop trying to predict stock markets and indeed elections. And he also says, predicting something else, but I forgot it now. But the point is, nobody can predict these things. So for example, in my network, but even in your network, and indeed most people's networks, probably less than 1% of people thought that Donald Trump would get elected. Less than 10% of people thought Brexit would happen. Less than 10% of people, even Donald Trump's supporters, thought the stock market would go up in the first few years after his presidency. And I don't even know one person who has predicted 2 or 3 things about this virus. I know one person who thought it would be very serious. I know another person who thought the stock market would go down, another person who thought it would go up. But the point is, I don't know anyone who has gotten all these things right. So don't try to predict, what's going to happen. But what's interesting though, is the markets have always historically returned to their past levels, and indeed more than returned. Of course, they've hit record highs. So what's been interesting about the last week is I've noticed a schism. There are those people who know this is a good opportunity to buy. Don't get me wrong. They know that in the next week, 2 months, anything could happen, right? Who knows? If huge stimulus is announced, nobody would bet against markets coming back strongly, or indeed going down, or staying stable, or being volatile, going up sometimes, going down sometimes. But there's a group of people who know that realistically, if they buy at these valuations, they hold for years and years and years. They're going to be fine. But then there's the usual crowd who say, oh, this is different, whatever, just as they did in 2008 or whenever anything happens, right? And that leads me, I don't like to make predictions at all, and this is not a prediction, but I have a strong hunch that in 5 or 10 years, the political blame game will kind of go into overdrive. Much like in 2008 and 2009, by about 2014, 15, 16, when markets were growing very strongly, many people said, oh, the economic crisis just gave the rich, as if they're a different category of people, a chance to buy low. When I can remember the economic crisis very well, and I can remember there was a hell of a lot of middle class people who had a little bit of money, lying around, but the majority of them didn't really take advantage of the market falls. I think come 2023, 2025, even maybe next year, we're going to start to see people saying, oh, this just gave loads of rich people an opportunity to buy low. But actually, you know as well as I do, right, there's a lot of people with cash out there. Not everyone, there's a lot of gig workers, there's a lot of people who are in poverty. But right now, there are a percentage of people on all ends of the economic spectrum who have liquid cash. There are other people who don't because they have a big mortgage, even if they're earning a lot of money and whatever. But the point is, a lot of people will probably actually blame other people for not taking advantage of this opportunity in a few years' time. And it'll even become a political issue, most likely. Now, linked to that though, this once again shows you should always have bonds in your portfolio. And many people say to me, well, Adam, look, bonds always go down, or not go down, but they never even come close to beating stock markets long term. And that is very true. If you look at any long-term graph of the stock market compared to the bond market, that's absolutely true. But bonds go up when stocks go down, usually. And in 2008 and now, bonds have beaten all our assets. Short term, so for example, 2008, 2009, bonds outperformed for 6 months. Once it was clear that the world wasn't going to end, stocks started to recover. Likewise now, stocks have done better. So if you have a balanced portfolio, you can merely rebalance from bonds to stocks, and then when stocks recover again, you can rebalance from stocks to bonds. So once this is over, never forget that it's always good to have at least some bonds. And especially if you're close to retirement, it's important to have some allocation to bonds. Linked to that though, there is a big misconception, and that's that gold is a safe haven. A lot of people, they know that gold long term hasn't actually performed very well. As I've said before, even though it's had its good periods of time of outperformance. Gold is basically where it was during the times of Christ. It's just kind of held its value. And even gold bugs admit that. But what many people say is they say, oh, well, gold performs well during crisis. Well, actually, that's not true. In 2008, gold was having a good bull run. And indeed, it had a bull run from 2000 until 2011. However, the one exception to that was in the very worst of the crisis, gold actually went down from about $1,000 to about $700 at the very worst of it. It went down by about 30%. Not as much as stocks, but then stocks recovered much quicker. And likewise, we're seeing the same here. Gold was going up for about a year. So after going to 1,900 in 2011, a record, it went down and down and down. But then 2 or 3 years ago, started to recover. And it hit 1,600, 1,700, but now it's down to 1,400. So the reality is when the going gets really tough, people go to the dollar, the yen, and indeed bonds. They don't go to gold. And linked to that as well, it should become very clear that Bitcoin cryptocurrency is not, something which people go to in the very worst of a crisis. So cryptocurrency has been hit even more than gold. So a lot of people who were worried about a market crisis, well, there's always people. Every year in history, there's been people who worry about market crisis. They say, oh, well, what about gold? And recently, what about Bitcoin? But actually, in reality, those people would have been better off in a diversified portfolio with bonds rather than gold or Bitcoin. And also, linked to one of my videos 2 or 3 times ago, I think a big aspect here is a lot of people don't plan for the worst. Now, I'm a big believer in optimism. I do think people should be optimistic, but realistically optimistic. By the same token, though, what a lot of people don't focus on is what I would call risks that can completely eliminate you. You could call them, let's say, ruin risk or something which is very severe. So, for example, most people worry about small dips in their income. But for most people, let's face it, it's not like you're going to die if you have a 1% fall in your income. But most people don't like to be self-employed because they don't like fluctuating income. Likewise, people worry about the stock market going down when it doesn't hurt anyone if you don't press the sell button because a decline and a loss is different. But very few people worry about their health until something happens, but that could obviously ruin you. And likewise, when it comes to crisis like this, what many people forget is the big losses are often due to the business models. And now, as what I mean by that is those people who never plan for something like this, not just something like this, but something like a terrorist attack as well, something that could, I don't know, completely change the face of civilization for a few months. Very few people consider these black swan events. Very few people thought, well, hold on, if I can't meet clients face to face, shouldn't I be having a business model that can do online? Now, everyone's moving quickly to try to go online, but they didn't try to focus on that risk. So the reality is, even people who are so-called risk averse, often they worry though about the wrong kind of risk. They worry about things like markets just declining and things like that. In reality, a lot of the risks that people should be worried about are things like, are they prepared for black swan events in their business? Another thing would be, are they going to panic sell? You should be worried about panic selling when markets are down, not actually a decline. Because remember, nobody loses money when markets decline. It's just a decline, it's not a loss. So, in summary, really, I think in a few years' time, unless the public policy response is very bad, this will come and go like anything else. But in the meantime, there will be a lot of opportunities for businesses that are agile, adapting online. And in addition to that, I think valuations will remain relatively nice for a long time. In terms of even next week, let's say markets recover 10% of their losses, right? But even at that level, it's still much below where markets were. So I think it's a great time to invest, although my position is always you shouldn't time the market. Markets always more than come back. So somebody who invested 1 month ago, 2 months ago, 3 months ago, they are not going to lose if they just hold out, add more when markets are down, rebalance, and so on.